Hello guys, my name is Basson van Rooyen. To my right here is John Morgan. Beside note, we're here from the Sanlam Investments Namibia Team, and we're really here today to start something new. And this is really a little bite-sized, compression from what we're seeing happening in the markets. We sit every day looking at the screens, trying to disseminate everything, trying to understand everything, and sometimes we miss just this chance to really sit back, reflect, and to really bring you along on that ride. So this is really the first, little recording that we'll do today, and we try and do it on a bi-weekly basis to really just show you some interesting tidbits that we see happening in the market. So John, today what we'll be sharing with the guys.
Thanks for that, Basson. So we're going to be looking at small cap stocks. One of the main driving reasons is because we recognize that small cap stocks in South Africa alone could have given you over 70% on an annual basis, which is it's quite impressive, I'd say. So just looking at the slide that we're presenting here, Basson, do you want to run us through that quickly?
Yeah, so I think, John, like you said, mentioned it's 70%, and that's really crazy if you think that from a COVID time, a lockdown time, a time where we're sort of seeing economies really struggling, to grow on the ground level, that there's really been this extreme sort of risk-on environment for the last 18 months. Last year we had equity markets sort of, contracting and dropping by sort of excess of 25-30%. But since then, it's been an incredible sort of risk-on environment, and as investors, if you wanted to stay in the conservative portfolios with interest rates being cut, you would have really been sort of struggling to earn sort of inflation-linked returns. So if you look at sort of just your Namibian cash, giving you about 4.3% over the last 12 months, and in this environment that it's been an incredibly risk-on environment, that you would have really wanted to sort of in hindsight being invested into these equity markets, but not only in the general equity markets. There's something very specific and interesting sort of sectors really sort of shooting the extremely well over the shorter term. So not only are you seeing the American market in sort of Namibian dollar terms, delivering sort of an excess of 12% over the last 6 months. You have some interesting sort of plays also coming out. And one is, even though we're talking about all this lockdown, all this work from home, and all this sort of retail online shopping, your retail property, your JSE property sector has been, one of your stellar underlying asset classes, sort of equity sectors performing excess of 50% over the last 12 months. So, where your top 40 or your Aussie has given you sort of more in the line of the 20% return of the markets. So it's been an interesting market, sort of, very much risk on, and very these subsectors performing one. And the other one that we talked about today is the interesting one that we're seeing happening is a small cap. Mm-hmm. The shares that are sort of very much unloved, overlooked. The SA Inc. one that we're all talking about. You sort of also the SA Inc. and sort of the negative sentiment around that. But that's really been delivering about an excess of 70% return over the last 12 months. And I think today is sort of just to really think about it, throw a bit of back and forth. Is this something that we're seeing? Is this a once-off thing? Is this something that we need to take sort of notice of? Or is this something that we just have to say is, man, it is sort of this meme stocks, this crazy market that we're seeing, and it's something to really be wary of. So I think if you can take us away, what we're seeing sort of happening international around the small cap stock, it's really interesting.
Absolutely. Just to run into the next slide. So I did put this slide together for a very specific reason. This is US data. It's annual return for small cap stocks. So your Russell 2000 here would then be your proxy for small cap stocks, and then have the NASDAQ and the S&P 500 in there as well. So it's pretty evident if you just look at the annual returns, it seems like small caps have almost underperformed more consistently than overperformed. So that to me is a very interesting phenomenon. But I like to look at the data, and not just the data, also the empirical evidence that's out there. So the small firm effect, or the size effect as they call it, was first introduced to the market through Barnes in 1981, and he basically showed that the small cap empirical data did not fully fit onto the capital asset pricing model. But to just bring it down to a more elementary level for us all to understand, that basically means if you had an investment strategy in which you invested only in small stocks in the JSE, I can't remember exactly what their constitutes were, not the JSE, it was in America, sorry about this, NYSE, New York Stock Exchange, then you would have made a risk-adjusted return, and that would have been a very active and well-paying investment strategy. However, moving forward in 2015, Eugene Farmer and Kenneth French, who I would say are the forefathers of finance in my opinion, they came up with a paper, the 5-factor model, and they basically proved that the profitability factor explained most of your returns in the small cap return. So that means when you were doing small cap investing, you were basically just replicating what you're doing when you're just looking at profitable stocks. But then as a rebuttal to that, one of their students, his name is Clifford Asness. He has a firm called AQR. Don't worry, we don't compete with them at all. But he showed empirically that if you do strip out the unprofitable small cap stocks, the small cap premium or the size premium, as I mentioned earlier, it does become statistically significant and robust. But what really tickled me was the title of his paper. He said that size matters as long as you control your junk. Junk obviously being profitability and unprofitable stocks being junk. So just to move it on and bring it back home, this is a slide that illustrates most of our asset classes, and I think on the three-year rolling basis return going back to I think that's 2007, 2008, if I'm not mistaken. Do you just want to take us away and explain a bit what we're seeing here?
Yeah, so I think the slide really tries and say, but is this a short-term phenomenon? They're seeing the small caps really outperforming, the rest of your equity sectors and equity classes. And this is sort of a slide that puts together, your 3-year rolling returns for your largest sort of indexes that we're seeing with the JSE. So you have sort of your Aussie, you have your resources, you have your property, you have your industrials, you have your financials. And there's some interesting things really sort of, highlighting in this. And the one you'll see is the red is the JSE J202, the small cap index, and the red dotted line is our small cap funds. It sort of came from a historical period, that 2005, 2008 period, really outperforming your larger cap, your top 40, your Aussie type of shares. Unfortunately, then going to the last 3 years, we've sort of seen that it's really been sort of an unloved sector, and the small caps really sort of lagging significantly. Your broader asset classes, your financials, your industrials, a lot wider over the market. The one outlier you see sort of being unloved and sort of underperforming was the resources, and that's one we've sort of seen doing very well, and that's sort of a great sort of addition to the portfolio. But interesting one, sort of resources being sort of a consistent outperformer over the last 4 or 5 years, but the one is now really that trends we're seeing changing in the last 3 months, and that's really what we're seeing. Interesting one, and I think the discussion about today is that small caps that's really shot the lights out and really jumped to sort of the top of the pile and really outstanding returns of the equity market. So it's really sort of a unloved category that I think sort of been sort of for most investors, investing into the active management space of the uncapped, it's been sort of a disappointing underperformance of your Aussie, of your index tracking funds. But this is interesting in the last sort of year that this has been one of your best performing asset classes in the equity space.
Right, so I think it'll be very befitting for us then to use the Sanlam Investment Management Small Cap Fund, which is a unit trust fund. Again, we're not trying to punt any funds to you here. This is more for discussional and trying to connect with our audience and our clients. So just to give you a quick review, this is a fund that would require you to have a high risk appetite. The fund is quite old. It was launched in 1997. It's still running robustly. And our benchmark there is the South African Equity Mid and Small Cap Index. So it's very important to know that. If anybody wants any more information on that, you can contact us. We'll put you in touch with our business development manager. But as fund managers, I think what we're more interested in is the returns and how it actually operates. So just to move on to the next slide here. This is a very interesting slide for me. I put it in here because I find it very interesting. And what you can see here is you can see the adaptive market hypothesis in play, which basically says that mostly markets are efficient, but in times of uncertainty, it becomes very volatile. And that ultimately means that your risk appetite changes over time. It has an intertemporal relationship. So as we can see here, it seems like if you go out on the curve, you're 5 to 10 years back, this fund itself did not perform better than its benchmark. Small caps in general also did not perform better than their benchmark. But as you can see now, the 1 year and 3 year returns look much better. We've also exceeded our benchmark quite significantly. And I think, Bason, do you just want to run us through why this has happened? What do you see actually ultimately changing the risk appetite of investors today in the market, not just in South Africa, but globally? So that I think it'll be befitting just for our clients to understand what risk they're taking when they're actually investing into these stocks.
Yeah, so I think part of the reason why I think it's sort of come from a period of being unloved, and I wish we always had a crystal ball to sort of look forward. But looking sort of back, from the market, that's been from a period that's been a risk-on environment, low interest rates, so really low discount rates being used, sort of very high valuations being put on equity markets, a lot of liquidity being driven into our equity markets, and this has really found its way really into the passive space in a large sense, into these big tech and the big name companies, and that's really what we've seen sort of, running to sort of extreme highs and historically high levels of the market. And I think, part of that is also now the market, sitting back and asking the questions that if we do see a change in interest rates, we see a change in the growth outlook of these shares. Is these prices being justified? And investors starting to look elsewhere to put their equity investments. And I think that's part of what makes this an attractive sort of asset class for the investors. That it's been a space that's been quite unloved. There's been a lot of talk around passive, going to the big liquid names, doing index tracking. And really sort of missing out on the active management of these shares and large portfolios, asset managers with very large books sort of overlook these very much because it's just too many names on their books, too small liquidity in the market, and something that's been overlooked, I think, over sort of the last 3 to 5 years. So I do think sort of from a value perspective, it does carry more risk, and we can chat about sort of how we manage that risk. But I think it's been sort of an unloved category and sort of been very negative sentiment around the SA Inc. as it's sort of dubbed in the market, that it's been sort of moving away from that and really trying to invest into these multinational, large tech or large name companies on our equity bourse.
Very interesting. I also think one very big important factor to consider is if you look at global monetary policy, it's every single central bank is pretty much dovish. That means interest rates are low, and as you rightfully said, these companies now have access to cheap capital. With all the excess money into the system through unemployment benefits being, I think, a bit unreasonable, but I digress. That's a story for another day. All this excess cash is now creating this risk-on environment, and I think that's the story we're seeing here with the small cap funds. So in terms of sustainability and looking forward, do you think we're going to have this risk-on environment longer than expected or shorter? I mean, it's of course, it's very difficult because nobody has a crystal ball. But for somebody who's looking to invest into these small cap stocks right now, do you think it's a good time or not?
Yeah, and I think that is the $1 million question. I wish we could all answer that truthfully or have the right answer in the back of our pockets. But I think from the way that we look at markets from a value investor, is to say that where do we see the most value, the most upside in our investments? And looking at how hard the equity market has been running in these tech names, the American names, it is just incredibly difficult to fathom that they can continue this trend for another 3 to 5 years. Where it is important, I think, to have a look at the portfolio and make sure that you diversify and take the right risk at the right time. And be careful of sort of putting all the eggs in one basket. And if we do see sort of a change in the growth outlook or an unexpected change in the interest rates, that you don't suddenly have a big market correction, that you're sort of being exposed to very volatile, very sort of future-dependent cash flow companies that's really discounted on a very, very sort of aggressive basis. So I think it is important for investors wanting to invest in this asset class to really sort of manage the risk. And as you absolutely put it, controlling your junk, as you sort of put it. And I think that's important, being from an active manager side, is really looking for that quality shares and not just taking a slice of the market, or making sure that you don't include sort of unprofitable, dwindling sort of companies sort of in sectors that are really struggling in the economy, but you really pick up that quality names in your portfolio. And I think it's important to really manage your liquidity, because this is a smaller asset class, and we're saying it's unloved. And part of the reason being it's unloved is because the larger investment houses traditionally shy away from it because of the low sort of liquidity in the market and transaction in the market, that if they would like to sort of move a large block, that it has a very sort of adverse effect on the market price. And then definitely you should have a longer investment horizon than your traditional equity index tracking. So I think really if you can sort of control those risk matrices, I do think this is a great addition to any investment portfolio that has an equity sort of allocation.
Right. I enjoy playing the villain. I enjoy the villain ethos, so I'm going to throw a spanner in the works and play devil's advocate here. I think what we're seeing right now in the market, especially the bullishness and risk appetite, it pretty much resembles the 99-2000 tech bubble, not so much the 2008 financial crisis. So if you just look back and exactly what happened there, as soon as earnings started missing expectations, we saw the whole system wobbling, everybody started panicking, everybody left. And I think one very, very idiosyncratic detail with these small cap stocks is that liquidity is a big issue. So I think it's a very difficult risk to quantify when you're looking at a market where everybody's trying to sell and you're sitting with an illiquid asset. What's going to happen is you're going to go straight to the ground with that asset because you're not going to have anybody to take it up. And I think that risk alone is a bit too much for me to be very hands-on with this fund. But then again, you're in the hands of a very good active manager, Sanlam Investments, and as you can see, they've returned stellar results against the benchmark. So it's really interesting that we disagree on some things, but we're still on the same team. In any case, we'd like to hear what you guys have to say. Comment, like, share, subscribe. Cheers.
Thank you so much.